Let's talk about the difference between the balance sheet and the income statement. The balance sheet is as of right now, right this second, as a point in time. What do you have? And accountants call those things assets. And what do you owe? Accountants call those things liabilities. What do you have and what do you owe as of right now? That's balance sheet. An income statement, in contrast, answers the question, how much did you make? And an income statement is not as of right now. An income statement is as a period of time. How much did you make last month? How much did you make last quarter? How much did you make last year? So balance sheet, point in time, right now. What are your assets? What are your liabilities? An income statement for a period of time, a month, a quarter, a year. How much did you make? The basic content of the income statement is as follows. Revenues minus expenses equals net income. That's it. We can all remember that. Revenues minus expenses equals net income. That's what we see on the income statement. Now, of course, we got to know what revenues and expenses are to understand what this is, but at least we can remember that. What are you going to see in the income statement? You're going to see revenues. You're going to see expenses. The difference between those two, net income. The key thing that we see in an income statement are the revenues. What does that mean, revenue? Revenue is the amount of assets created through doing business, from selling goods or services. So let's use some specific examples. If I'm talking about Walmart, revenue for Walmart is the amount of assets created through selling products. So when Walmart sells you a product, they create an asset for themselves, your cash typically. They also sell memberships. If you've Sam's Club memberships, they generate assets, cash for themselves through selling memberships. So revenue is the amount of assets that Walmart generates through doing business, selling you a membership or selling you a product. Microsoft's revenue is the amount of assets that they generate through selling you software and a little bit of hardware as well. So it's the revenue represents the amount of assets created through those activities. Disney generates revenue in many different ways. Disney generates assets through their media networks, television, through their parks and resorts. Oh yeah, you've been to Disneyland. You know what I'm talking about. Through their studio entertainment, so you've seen their movies, and through their consumer products. Some of you've got Winnie the Pooh in your bedroom. When you bought that, from Disney's standpoint, they created revenue. They generated assets through selling you that product. So revenues represents the amount of assets created through doing business. Now, to tell you the whole story, revenue can also be generated by satisfying liabilities. Let's say that I owe somebody some money, and they say, listen, you got a business, right? You owe me some money, right? Yeah. Well, instead of paying me back, go ahead and do some work for me. I'm satisfying that liability by doing work. So revenue is the amount of assets created or liabilities satisfied through doing business. We'll generally use this definition right here of assets created. But remember, revenue can also be the amount of liabilities satisfied through doing business.